Welcome back, guys. Welcome back to sort of our ongoing commentary in the markets, where we share our market insights. Let's start with, this is the second full trading week of the year. And this is where market participants are back at their trading desks, and we expect trading volumes to rise back to normal elevated levels. The first trading week of the year saw plenty of volatility in the markets, and that was, I would generally say, due to light volumes is one of the first sort of key areas there. So illiquid sort of market conditions allowed for more volatility to take place. And the focus is around the Fed. Okay, so we had the Fed minutes that had come out Wednesday evening, 7 p.m. UK time. And with the Fed minutes, what was indicated is the likelihood of a earlier rate rise in the US, as well as a much earlier start to the process of reducing the Fed's balance sheet. That had spooked the markets, and almost we saw an instant reaction across all asset classes. The first one that I'm going to focus on is the one that you can see here, is the US 10-year yield. This had risen. Okay, so this is inversely correlated to that data, so that this will move in a positive direction. So we would have seen a lot of strength come into the yield. Okay, so now if there is a expectation of a rate rise, then naturally the yield itself will also be higher. And therefore we saw the yields, the US 10-year yield, and across the board from the 2-year all the way up to the 30-year yield had all moved in the same positive direction. So that's one of sort of the emphasis there on from the same sort of aspect, but looking at sort of something that had moved in the negative direction, we would have seen the Nasdaq. Okay, so the Nasdaq, tech stocks are quite heavily weighted when it comes to interest rates rising. Okay, so if interest rates are rising, it's going to have mostly a negative impact on tech stocks, due to sort of forward PE ratios and valuations. Okay, so yeah, we saw sort of tech stocks come back to sort of key levels. Now, if I go to a daily time frame, and just if I have a quick look at where these moving averages are, let's maybe. Okay, so we'll just focus on sort of price actions. Just looking at the price action, you can see we're back at these key level lows. Okay, so the last time we was here was the 3rd of December, and then also the 20th of December. So we're back at sort of these key level lows. You can almost potentially see this as a double top. So we've got sort of 2 key levels of resistance up there around the 16,680 mark as well. So Nasdaq weakness, and across the stocks and the equity markets, we saw weakness. We also saw not just the dollar index. The dollar index, let's just remove that symmetrical triangle, which is no longer intact. We've seen the dollar index still at the highs, not much of a sort of, direction as of yet, right? So you can see overall, the year 2020 had been sort of 2021, sorry, had been a very positive direction for the dollar index. Okay, so we've seen sort of, from these lows where, just starting the year, was at sort of super lows around sort of below the 89.50 mark. Since then, we've traded back up to around 96 handle, reaching a high of around 97. Okay, so we reached a high of 97. So we're still trading at these highs, but again, a little bit of weakness most recently. But overall, we're expecting dollar strength to continue as, the expectation of Fed to taper, but also rate rises and also reduction of their balance sheet. Is all the sort of three key components that are being discussed at this current moment. I think what really spooked the market was that reduction in the Fed's balance sheet is a potential has a very strong likelihood of occurring in the coming months, by March. So yeah, so the Fed is what had driven the markets from from last week's price action. Now, if I come over to sort of the economic calendar, let's just have a quick look at the economic calendar over here. So looking at the next key relevant impact from last week was, of course, non-farm payrolls. Okay, we had non-farm payrolls. Now, the emphasis for the non-farm payrolls, the expectation was 426K, okay, 426,000 jobs, okay. But, you know, the market did not achieve that, okay? The market did not achieve that. Some had forecasted 200, 250. Someone said close to 5, you expected 500. What it came out was actually just shy of 200K, okay? Just shy of 200K. But how relevant is the non-farm employment change, right? Because it's an employment change based on non-seasonal factors, okay? But at the same time, if you have this data that comes out, which is the unemployment rate, back below the 4% mark, okay, it's back below the 4% mark. It came in at 3.9% in comparison to the prior, which was at 4.1, or sorry, 4.2% was the prior. It was expected to be 4.1%, came in at 3.9%. So we're seeing the unemployment rate reduce. At the same time, average hourly earnings, so, you know, the earning potentials had also risen. Okay, so we can see average hourly earnings had risen to 0.6% from prior at 0.3%, where the expectation was at 0.4%. So we had two very strong positive data, which almost negated this actual non-farm employment result that had come through. So what is concerning? What is it concerning going forward is the US economy overheating? Okay, that's the biggest concern. Now, with the Fed putting on the brakes by, you know, tapering, discussing reduction of balance sheet, and putting on the table potential 3 rate hikes this year, clearly they are seeing an overheated economy. Okay, and that's what's one of the sort of key themes for the year ahead, if not for the quarter ahead. So those are the sort of the major factors from last week that I could take away, and I would say is the most relevant to be aware of moving forward into this week. Now, coming back to sort of the economic calendar, just looking at the week ahead. Okay, so let's look at the week ahead. So let's go into this week. Now, it is a quiet start to the week ahead. It's a quiet start to the week ahead. As you can see, mostly low impact news, mostly low impact news. In Japan, you have a bank holiday, you've got some building approvals that had come out overnight, but mostly sort of, you know, the euro unemployment rate might be one of concern, but not as much. Okay, so it's suggested to be reduced by 0.1% from 7.3 to 7.2%, but again, not huge, you know, not much relevance there. Going into Tuesday, again, Tuesday itself, the day ahead, sort of the London session, I don't expect too much to occur, but in the US session is where we have a lot more speeches to take place, and that's where the concern can be for the markets. Okay, so we have FOMC Mester and George to both speak in the afternoon, and then of course we have Fed Chair Powell testifying in front of Congress as well. Okay, so his testimony will be taking place. Now, that is where the relevance is going to be, is the key speeches that are coming through. The key sort of what we're looking for is those hawkish tones. Okay, we're not expecting any Fed member to be dovish at this current moment, of course, so don't worry about the dovishness. We're looking at how hawkish are they, and what is their views of the economy? Are they suggesting the economy is overheating? Okay, and are they suggesting that they are going to be more hawkish than previously expected? We've already seen in the minutes that most of the members, the board members of the Federal Reserve, have suggested a more hawkish tone. Okay, will that come through in the speeches? That is what we're looking for. So just be mindful of the key takeaways that you take from those speeches. Moving on from there, going into Wednesday. Now, this is where the data comes into play. Okay, and of course, you know, well, overnight, we have from China, the CPI and the PPI, but what's going to be most relevant is the US inflation rate. Okay, so the US inflation numbers that come through. We have the CPI month-to-month figure, 0.4% is what is expected. The prior was 0.8%. This is month-on-month figure. But of course, you know, we have the core CPI, which is going to remove some of the sort of seasonality part to it and just focus on specific area. As you can see, sort of what it does exclude is excluding food and energy. Okay, it removes food and energy from the basket of goods and services that it reviews there. Right, so the CPI is going to be very relevant. Now the second theme, and what is leading the Federal Reserve to become extremely hawkish is inflation, right? Inflation being at surpassing those figures that we've seen previously and at the highest level for many, many years. So yeah, just be mindful of that inflation sort of figure there. And then moving on to sort of the rest of the day, we have crude oil inventories. The beige book is an important one. Again, now this is looking at sort of each Federal Reserve within this multiple states of the US that all give their view. Okay. So and you got another MPC member Cunliffe to speak as well. So a lot of Fed speeches expected for the week ahead. So that's what we can focus on Wednesday, and then on Thursday again we're looking at more data when it comes to the US. We have PPI month on month, and then core PPI. So the secondary inflation figures coming through there, and then we have unemployment claims. So that's a sort of key focus there. I might also review the ECB economic bulletin, gives you sort of a high level overview for Euroblock. And then as we come to the end of the week, we do have firstly the ECB President Lagarde will be speaking in the afternoon, but most importantly we have core retail sales and retail sales coming out from the US. So you can see how data-wise and speech-wise, a lot of the focus is going to be in the US, okay? That's where the focus is going to be, is the US markets. So what I would suggest for trading the week ahead, you could trade very technically the London sessions for the week ahead, because of the low impact news that we have. And you'll be also reviewing what happened yesterday. Okay, so if we had the CPI data come out, the London session, I want to be mostly trading around what the market participants' views are around that CPI data that came out the previous day. Okay, so we expect the London session to continue those US momentum or US direction. And then in the afternoons, just be mindful of the data and the speeches taking place. Reduce your position sizing is a key area to focus on, especially when you have high impact news that are coming out and speeches taking place, which can lead to volatile moves and erratic price action. Okay. Now, finally, sort of the last sort of key factor to be mindful of for the week ahead is on Friday, we will have earnings season beginning. Okay, so we have earnings season kicking off. So now with earnings season, the key factor that I would take away from trading a macro standpoint, and you have assets that you're trading from a macro view, is just looking at it from a high level perspective, right? And grouping the types of stocks and the earnings that are being released on an ongoing basis. So for example, Friday, just let me have a quick look here. Just looking at Friday, I believe it's focused on banking stocks. Okay, so if we're looking on Friday, we're focused on banking stocks that are going to be released. So therefore, you're looking at financials. Okay, you're looking at financials. You're going to see how they weighted, how they expected to perform based on their estimates. And we'll see what takes place when it comes out. And that's going to lead market direction. Okay. Now, apart from earnings season, I don't see anything else. Okay. So the factors are that the key themes for the week ahead is we have a lot of data and speeches that's going to come around the US session. And it's all going to be giving us an indication of how the US economy is performing. Is it overheating or is it just, in the Goldilocks zone, not too hot, not too cold, not overheated, not sort of under either. So that's the key sort of view that we want to take there. But at the same time, earnings season is going to be very important. What we're going to see is how our individual companies performing overall to sort of the estimates and what indications are they giving to us around their economic and business environment currently. So those are sort of the major factors when it comes to looking at the economic of the week ahead. Now, assets wise, some of the assets that I'd be focusing on. Well, we spoke about the Fed, we spoke about earnings season. I've gone through the US Treasury yield. We've spoken the dollar index. The dollar index, it's finding it hard to rally at this current moment because as the Fed has surprised more on the hawkish side, the truth is that the market is now pricing a lot more tightening from the Fed. And that just gives more of a tailwind, more of a directional move for the yields rather than the dollar index itself. But the dollar index is likely to follow suit in the sort of coming sort of weeks. So as we've seen these yields rise and equities drop, so the dollar, it's finding, it should find a little bit of balance, but eventually we're looking for more of an upside move there. Now, looking at the euro, let's bring up the euro dollar. Let's have a look at what the euro dollar is doing. Euro dollar sort of at these key levels of lows. We're around the 113 handle. Okay, so we went on to test the 113.50. We reached down to close to a 112 low. It's also at a very key level of support, and it's struggling to find direction at this current moment. That's what we're looking for, is direction. Inflation is not just rising in the US, it's rising in the Eurozone. Yeah, and this could soon drive the ECB members to become more hawkish. So that is what is going to drive the euro to the upside direction, is the ECB to give a more affirmative decision making in regards to managing inflation. And so far they have not shown that. They've been very accommodative. So that's what we're looking for. And we do have, as I mentioned, Christine Lagarde to speak towards the end of the week. So let's see if there's any key notes that we could take away of them turning more hawkish. Looking at the pound, let's bring up the pound. Pound, slightly better, moving more to the upside, but overall we have a downward trend over here. You could clearly sort of see a down trend line being applied from those highs, something similar to that. We're fast sort of approaching that key level there. So the pound continues, it's been last week was a previous, you can clearly see last week was a very strong week. So starting this year so far, so we've seen a very strong move in the right direction. The pound and even the UK 100, the FTSE 100 has been sort of massively underweight in comparison to all other equities in the year 2021. So the pound, is continuing some strength. But it may find some resistance at this trend line now as we fast approach sort of, a key level. Okay, so as we're fast approaching this key level, it might find some resistance. From a fundamental standpoint, just going to be mindful of sort of the cases that we've seen in the UK. Okay, so just looking at case-wise, let me just have a quick look at what the case-wise, what does the cases look like? I had it here somewhere. Okay, so UK cases. I'll just bring out in a second. Okay, UK reported 141.5K new COVID-19 cases and 97 deaths on Sunday versus 146.4K new cases and 313 deaths on Saturday. So that's what's being seen at this current moment. But there is Tory COVID recovery group chair Harper has called for PM Johnson to end all COVID-19 restrictions in England later this month. We've already seen one reduction taking place, which is the travel restriction. Okay, one of the travel restriction was before you come back to the UK, you had to do a you had to do a PCR test. That's been removed. That's been removed. So it's made as over the weekend, I think they were calling it Summer Day or something like that, where there's a large number of bookings taking place. I think Jet2 Holidays got 200% gain in their holiday bookings. So, we've seen some reductions in the restrictions that we have at this current moment. But the hopes are by the end of this month, we may see a lot more reductions taking place in the current restrictions we have, purely because of hospitalization and the death rate is so low when it comes to the Omicron variant. Okay, but one of the key tail sort of end concerns for the UK is the fact that there is a very strong staff shortages, okay, in hospitals, where they are now contemplating, instead of a 7-day, I think it's a 10-day, 7-day where you're restricted to stay at home if you test positive or show any of the sort of key symptoms. Now it may be reduced down to 5 days. Okay, so 5 days, but again, 5-day isolation. May be beneficial, where we may see a reduction in the staff shortages that we've seen so far. But overall, we're moving actually in the right direction, even though we've seen these COVID cases gain overall. Now, so let's see how that has an impact on the pound going forward. Commodity currencies, when we look at sort of, say, the Aussie, the Kiwi, the CAD, the NOK, all of these are showing some resilience and traded broadly flat. The yen is slightly down. The yen is a great asset or a great FX currency to view if you want to look at whether it's risk on or risk off. Currently, it's more risk on, even though we've seen risk off factors from last week with the equity market selling up, but we've not seen a lot of strength going into the yen. And we've not seen a lot go into gold. So looking at gold still sort of not surpassing any key levels of resistance. It hasn't surpassed the 1834 level. So we're still in a sort of Goldilocks phase where we're more towards risk on. We've seen some risk off factors coming through, but no one's panicking and moving to safe havens. That's the key point there. Okay, so most likely we're seeing more pressure going into yields. Okay, so yields are more in demand. Okay, so yeah, when it comes to gold, as I mentioned, it's underperforming, and that's going to take place when yields rise to the upside. So we're seeing yields rise sharply, and that's gonna, again, gold once again fell to sort of break through the 1830 figure that I've just shown you now. Silver's also performed even worse, and we're seeing sort of usually low volatility in the silver. Okay, equities, as I mentioned already, equities are now starting to really sort of get worried about rising yields. Okay, so that's the key concern. And sort of looking at the Nasdaq, that reflects that. Looking at sort of the S&P 500 and looking at the Dow. Okay, so those are sort of three key areas that is showing that there's this the rising yields and inflation is a big concern. It's almost if they didn't believe the Fed that they are going to tighten substantially, but the message is starting to sink in now. Okay, that that the Fed are going to be more responsive when it comes to the inflation sort of going forward. Looking at the DAX sort of reaching back up to sort of those all-time highs and a bit of a correction since. The FTSE has breached through sort of a key level of a trend line. Okay, so it's more in the upside direction if you're looking at most recent price action. So European equities are actually outperforming. European equities are outperforming US counterparts. As I mentioned, bonds are going to sell off. If yields are rising, the bonds are falling. So that's just part of it. The sort of correlation of asset classes. And yeah, if the Fed is to finish their taper by March, and and a hike takes place, that surely means that bond yields should be much higher. And then in theory, then the bond market's going to be seeing a lot of weakness moving forward, going ahead. Okay, so just be mindful of that. And of course, finally, coming over to some of the crypto assets, which have been following the same theme as all other markets. Okay, the bond markets, how we've seen bond yields rise, we're now seeing cryptos also fall with the view that, okay, now a reduction of their balance sheet, a reduction of the Fed's balance sheet, QE, is a key factor to what had risen the price of Bitcoin from around 10,000 up to around 30,000, and thereafter around 60,000 figure. Okay, the amount of money printing was taking place in the US. That's what led to a large bullish directional move in the price of Bitcoin and most crypto assets. Now, with the reduction of their balance sheet, that gives a little bit fear in the markets, a little bit fear in the markets, and that's why we saw a bit of a crypto sell-off. But there is something else that you may not be aware of in the crypto space. There is some unrest, geopolitical unrest taking place in Kazakhstan. Now, with that taking place, do remember there are 18% of the mining that takes place is in Kazakhstan, and that we saw a reduction of the hash rate taking place. Okay, so that could be sort of a correlation there, that where we saw a bit more selling off taking place in the crypto markets due to that concern. But yeah, I mean, I'm seeing, Bitcoin around the 40,000 figure, staying above the 40,000 figure. We could, it is in a downtrend. The short-term view is it's moving towards the downside. Okay, so you have to go with price action. What is price action showing you? Price action showing you this is in a downtrend. We've got a series of lower lows and lower highs. You can see the crossover between the moving average. Even though we're at a key technical level around the 40,000 figure, but you could clearly just put a pending order just below here, pending order for a short just below here around 39,300 figure, back down to sort of these key levels around 30K mark, right? That's something that might be worthwhile doing, just putting a pending order and seeing if, if the market does sell off and you have a large move that takes place in a very short period of time, you don't miss out on that action. And at the same time, you can also have more of an upside view as well by placing a pending order. And that's what pending orders are fantastic for, is, placing them at key levels, walking away when the market moves. And sometimes it moves, in times that you're not active in the markets. It might be overnight, it might be over the weekend. You won't miss out on that action. Okay. And that's something that I'm looking to do going ahead with Bitcoin in the upcoming week, setting up some pending orders. ETH is around the 3,000 figure again. Okay, we're back down to those 3,000 figures again. We're seeing a larger correction taking place in Bitcoin and the crypto markets and the crypto ecosystem itself. Now, there was a lot of discussion whether this is the crypto winter, and a lot of individuals have refused a crypto winter, but it does seem that we are in a very bearish trend. Okay, we are in a very bearish trend. Short term, you got to be negative. Short term, you got to look for more selling pressure. Okay, go with price action. Always go with price action. Everything is in price action. Okay, right. That brings us to the end of this weekly market sort of brief, and the next brief will be at the end of this week, where I'll cover some of the key charts that moved and what trades were worked out well, what trades didn't work out so well. We're going to have a sort of a post-market review of the markets.